On March 13th, 2023, in New York City, a critical incident unfolded in the financial markets. The main actor in this scenario was a prominent trading firm, AlphaTrade, known for its advanced algorithmic trading strategies. AlphaTrade had developed an automated system that analyzed minute fluctuations in market data to execute trades, allowing rapid decision-making in a high-frequency trading environment. This system relied heavily on machine learning models that had been trained on historical data to predict short-term price movements across various asset classes. However, on this day, a fundamental misalignment in AlphaTrade's trading algorithm initiated a series of errors. The algorithm misinterpreted market signals due to a combination of inadequate training data and a misconfiguration in its signal processing module. Specifically, an assumption coded into the algorithm concerning expected volatility levels was outdated, failing to account for recent shifts in market dynamics caused by geopolitical events. This misconfiguration acted as an access vector, allowing inaccurate predictions to propagate through the trading system and market environment. As AlphaTrade's algorithms began executing trades based on these flawed readings, market conditions deteriorated rapidly. Within hours, the firm faced a cascading failure in its trading operation. Traditional risk management systems were incapable of responding effectively due to the unprecedented surge in trading volumes. As sell orders triggered across multiple asset classes, the buy-side liquidity drained perilously low. The disorder resulted in a collapse of liquidity across platforms, leading to severe price dislocation in securities. In quantitative terms, trading volume surged by over 150% compared to average daily activity, creating a chaotic environment where stocks fluctuated wildly. The immediate impacts became evident as AlphaTrade's algorithms executed large-scale sell-offs. Within the first hour, the firm reported losses exceeding $30 million as the market reacted disproportionately to the algorithm's transactions. Moreover, numerous other firms utilizing similar trading strategies were inadvertently drawn into the turmoil, amplifying the effects throughout the financial ecosystem. As financial institutions scrambled to assess their own exposure and mitigate risk, alarm bells began ringing within supervisory bodies and trading networks. Internally at AlphaTrade, the initial response was marked by confusion and miscommunication. Teams within the firm attempted to diagnose the problem, leading to a flurry of internal emails across departments. The incident channel was inundated with messages as analysts reported unusual trading patterns while quant teams tried to ascertain the root cause of the misalignment. Some members incorrectly attributed the chaos to external market conditions rather than an internal technical failure. Initial attempts at partial fixes involved rolling back certain algorithmic parameters to restore normal operations, but these measures proved ineffective given the scale of the disruption. Simultaneously, external signals began to surface as user reports flooded in from retail traders and institutional investors who were experiencing significant losses. Monitoring alerts from various trading platforms accelerated, indicating abnormal trading activity and price swings. Minor media mentions emerged, pointing to heightened volatility in the markets, but initial coverage lacked depth. Observers remained cautious, with industry analysts noting the potential for broader implications if the situation escalated. As the hours ticked by, market players grew increasingly concerned. Updates from AlphaTrade were sparse, leading to speculation in financial circles about the firm's capability to manage the unfolding crisis. Investors scrambled for clarity, and panic began permeating the trading floors of many institutions. The situation was precarious, with the market poised on a knife's edge. Driven by algorithmic trading systems misaligned with real-time dynamics, in the background, regulatory bodies that oversaw the industry began internal discussions about the broader implications of the incident. As alarms sounded in trading hubs worldwide, the potential for systemic risk became a point of contention. Assessments were launched on whether existing governance could mitigate the threat posed by algorithmic misalignment and whether reforms were necessary to safeguard the financial system against similar future incidents. As panic continued to grow, AlphaTrade's leadership convened a crisis management meeting to evaluate their response strategies. Their next moves would shape not only the fate of their firm, but also the broader financial landscape. At this critical juncture, the stability of multiple digital infrastructures hung in the balance, suspended in an atmosphere thick with uncertainty and the prospect of further upheaval. Structures through rapid sell-offs, the revealed weaknesses in their algorithmic architecture compounded the issue, demonstrating that the firm's distress was no longer an isolated unfolded incident. As AlphaTrade's algorithms continued to execute trades based on erroneous market signals, alerts from affiliated trading venues revealed that other firms were experiencing similar anomalies. The systemic nature of the issue began to take shape, leading to a drastic and swift amplification of the consequences across the financial sector. In the ensuing hours, reports emerged indicating that losses in the sector cumulatively reached upwards of $1 billion as multiple algorithms across various firms misfired due to confusion sparked by AlphaTrade's initiation of the sell-offs. A staggering number of retail investors, over 100,000, were shortly impacted, with many reporting that their positions liquidated at a loss far beyond expectations, leading to widespread protests in the trading community. The crisis hit a variety of sectors especially hard, notably tech and retail stocks, where prices plummeted over 20% within days. Major market indices such as the Nasdaq and S&P 500 exhibited downward trajectories, resulting in principal losses for countless institutional investors. Regulatory authorities like the SEC and CFTC took notice, and emergency measures began swiftly unfolding, including a temporary halt on short-selling practices in affected securities as the data illuminated unapparent vulnerabilities throughout traditional and automated trading infrastructures alike. As AlphaTrade struggled to regain its footing, its communications remained sparse, leading to an erosion of trust among investors and stakeholders whose expectations were not being met with adequate or timely information. Over the next couple of days, the firm faced intense scrutiny. By this time, outside analysts and journalists began to piece together the narrative of cascading failures and algorithmic misalignment. Investigative reports were published citing the breakdown of internal communications and the alarming inability of financial governance to address the issues arising from rapidly evolving trading technologies. Specialized financial journalists disclosed early internal communications obtained through whistleblowers that highlighted ignored warnings about the algorithm's predicted vulnerabilities and the firm's decision to prioritize short-term gains over robust testing and human oversight. In the wake of the media frenzy, AlphaTrade's leadership was forced to confront the immense public and regulatory backlash that followed. As they took steps towards crisis management, they implemented immediate internal audits to assess their algorithms' frameworks and reevaluated risk management policies. Moreover, they decided to suspend all trading activities for the foreseeable future as an emergency measure and collaborated with external cybersecurity firms to perform a thorough forensic investigation. Within days, AlphaTrade received a subpoena from regulatory bodies demanding detailed records surrounding the algorithm's configurations, trading activities, and risk assessments conducted before the incident. On the regulatory front, an emergency meeting convened at the SEC addressed the burgeoning crisis, unveiling discussions concerning potential updates to rules governing automated trading practices. Legal representatives from affected firms and industry stakeholders presented evidence underscoring the algorithmic failures. A comprehensive investigation was announced aiming to provide structural insights that could inform a new set of trading regulations intended to safeguard against future incidents of a similar nature. As months passed, AlphaTrade navigated through the tumultuous after effects of the debacle. However, despite implementing some changes, the damage to their reputation proved irrevocable. Institutional investors began pulling out significant capital, and retail clients flocked to alternative platforms that promised stronger oversight. By the end of the quarter, AlphaTrade was forced to announce substantial layoffs amounting to approximately 30% of its workforce, followed by a restructuring plan aimed at stabilizing operations. In the longer term, regulatory audits revealed a lack of compliance with existing best practices, culminating in hefty fines imposed on AlphaTrade and additional measures mandating thorough reviews of algorithmic trading strategies across the board. The SEC recommended an industry-wide shift towards transparent algorithmic decision-making processes alongside more rigorous pre-trade risk assessment tools, reflecting a broader awareness of the necessity for compliance in an increasingly automated landscape. By late 2023, AlphaTrade had exhausted nearly all liquidity and was compelled to enter into a strategic partnership with a larger financial institution, effectively becoming a subsidiary and transitioning leadership in the wake of high-level resignation. This acquisition aimed to leverage the parent company's infrastructure and resources to remediate the damage and restore confidence in their trading systems. In conclusion, the incident stood not just as a cautionary tale for AlphaTrade, but as a paradigm shift within the algorithm-driven trading landscape. Firms revisited their risk management processes and contingency measures with renewed rigor. Transparent trading practices became a focal point of discussions in regulatory circles, illustrating how rapidly evolving algorithms algorithms require not only deep technical scrutiny, but also heightened ethical considerations regarding their deployment in real-world financial markets. As of October 2023, AlphaTrade operates under new leadership and structures, having adapted their strategies to align with stricter regulatory guidelines while striving to restore their reputation. The financial sector continues to grapple with the lessons learned in the Adani, emphasizing the need for an adaptive governance framework to manage the risks posed by algorithmic misalignments.